Hello, everyone, and welcome to a Trustee's Guide to Life Settlements, which is the title of our presentation today. Welcome, and again, my name is Leon Wessels, and I will be the moderator for today's session. I'm pleased to have Aaron Hansen and Michael Brohan join us as our presenters. I will be introducing both in just a few minutes. On behalf of ITM 21st Life Insurance Trust Company and my associates John Barkhurst, Joe Gausted, and Aaron Hansen, as well as our strategic partners Judith Pearson, Kelly Kiefer from Nomadic Solutions, and Michael Brohan from Your Life Insurance Solutions, we want to thank you for attending today's session. Today's event is the fourth webinar since the restart of the ITM 21st University Education Opportunity. If you find that your time is well spent and the information helpful, please share with your friends and colleagues. If you're not already signed up to receive our weekly blog, you can do so at the ITM 21st website. We are going to use the GoToWebinar platform for our session. Each will be recorded and available on the ITM 21st website under the Education tab. The phone lines will be muted except for those who are listed as panelists. And I encourage you to ask questions via the questions chat box, which is on your screen. We've allocated time at the end of the session to answer any that arise. If you have a question that you do not want to have addressed openly, you can indicate so and we will respond privately. Our continuing education, all sessions are free of charge, even those seeking such credits. All webinars are submitted for 1 hour of CTFA and CFP credit. And for those of you who are members of FIRMA, you may also receive credit for today's session. To receive your credits for today's session specifically, please click the download button on your screen. There's a download under the handouts, which would be for your form to submit for your credits. Please complete that form and return it to the ITM21U at itm21st.com within 7 days. If you have questions about the credits, please send us an email and we'll address those as quickly as possible. We are grateful to the ABA and the CFP organizations for recognizing our sessions and allowing us to provide you with these credits. We are required to provide you with 50 minutes of approved content, including time for questions. We can only provide continuing ed credits to participants who have been logged in and attentive for the full 50 minutes. While we realize that distractions will and do occur, we ask that you do your best to help us meet those standards. Our faculty continues with John Barkhurst, Aaron Hansen, Michael Brohan, Judith Pearson, which are kind of our regulars. And then we have guest speakers, which next week we will feature Kevin Maas from Pool Consulting. And the following week will be Rachel Green from Team Risk Management Strategies. Our schedule for June 24th is titled Directed and Delegated Trust, The Risk of Confusing the Two, by Kevin Maas from Pool Consulting. A little synopsis on that session goes as follows. Join this webinar to learn more about the business, legal, and regulatory differences between directed and delegated trusts, what the issues are in considering each model, and what your organization can do to manage the business, fiduciary, and regulatory risks. Additionally, a consideration of and comparison to trust protectors will be discussed. The duties of trustees and the risks that must be managed by a trustee are changing. Kevin will identify and compare the unique risks presented so that you can effectively manage these in the directed trust, delegated trust, and trusts, which include a trust protector. So please join us. If you're not already registered, you can go to our website, get registered for that event. I know we have good numbers already signed up for that. On July 22nd, we'll have a session titled Paying Caregivers and Employees from a Trust and Staying Out of Hot Water. And that the presenters there will be Rachel Green and Cheryl Severson from Team Risk Management Strategies. Today, we're going to be trying something new. We have a GoToWebinar has a polling feature that we're going to utilize today. So bear with us as we try this. We may have a hiccup or two, but we'll figure it out. And to ensure that everyone is aware of and how to participate, I've posed a sample test question. So please, on your screen here momentarily, you're going to receive a question. We ask that you answer it, yes or no, and then shortly after that, we'll close the polling and then a screen summary will show up, and it'll provide a percentage breakdown of how everyone answered. So please, everyone, look at your screen and answer the question, because of COVID-19, I am working from home. Yes or no? Pretty simple. We'll give you about 10 seconds. And hopefully everybody will participate, because I can tell who is and who isn't. All right, Aaron, let's close that up and let's get a response. Let's see if this, wow, that's fast. 73% have indicated they are working from home. Now, I know Mike sometimes works from home for no reason, but most of us are doing it because of our business continuity plans. So we're going to get to it here in just a second, but first, Americans are very good at playing the short game. We do well at focusing on what we want today and what will advance us in the moment. However, life is about much more than fulfilling our personal desires. We open up a whole new dimension of joy and fulfillment when we realize that life is about what we give to other people. Sometimes our gift to others is our integrity. Other times it's our time and energy. This paradigm shift starts by recognizing that our choices today affect people around us as well as the next generation. That's why Simon Sinek, the British-born American author, I should say, and motivational speaker, stated, "To ask what's best for me is finite thinking. To ask what's best for us is infinite thinking." And that's today's Winner's Minute by Mac Hammond. Our speaker today are two speakers, very familiar with each other, quite interesting actually. Mike Brohan was the original remediation guru within our organization, and his number one person was Aaron Hansen. So we have brought them back together today. Aaron is a CLU and responsible for managing the Totally Policy Remediation Services as Director of Remediation for ITM 21st. Aaron and his team provide policy analysis, life insurance review services to trustees, advisors, grantors, and beneficiaries under the ITM 21st managed solution. Joining the firm in 2010, Aaron helped develop, refine, and implement the remediation process and systems that are used today. Additionally, we have Michael Brohan, who's CFP, CLU, and CAP. He was a pioneer in the trust-owned life insurance world. Michael now works with trustees and wealth advisors nationwide, helping them navigate the life insurance marketplace. His time in the Totally world taught him the benefits of developing prudent practices to buy and sell life insurance. His ability to bring clarity to a confusing marketplace allows his clients to move forward with confidence. Michael has enjoyed educating peers about life insurance, especially in the trust, accounting, and legal community. Michael has also been a speaker at numerous national events, and in 2019, he published his first book, The Wealth Advisor's Guide to Life Insurance, which really isn't true because he really first published our book, which is called The Totally Handbook. So with that, I will turn it over to you, Michael.
Thanks a lot, Leon. Thanks for the introduction. And it's really good today to be here with people from ITM 21st. Obviously, I have great respect for the company and the people there. You know, life settlements is our topic today, and it's getting a lot of attention in financial publications and even on commercials on TV. So your clients are becoming much more aware of them. So I'm glad we could gather and talk about life settlements in a trust setting. I think everybody's going to get a lot out of today's session. I wanted to make sure that everybody knows to download the handbook. It's a 14-page handbook, and a lot of what we're going to go over today is in the handbook, and I wanted everyone to have something that they could take away from the session and refer back to in their own practice. So taking a look at today's agenda, we're going to start by talking about what a life settlement is, and then we're going to talk about the history of life settlements. How did they come about? Why is it that you're able to sell a life insurance policy? Then we'll talk about why investors buy life insurance policies and why your client may want to sell their life insurance policy. Then Aaron Hansen's going to take over and talk about the life settlement process, and he's going to take us through 2 life settlement cases So you see the process for a life settlement. And then I'm going to come back and talk about taxation of life settlements. And then we're going to end with a method for trustees to follow to go through the life settlement process prudently, which is probably the most essential part of the session today. So starting out, what is a life settlement? The simple definition is it's the sale of a life insurance policy to a third party for more than its cash value and less than its death benefit. The seller is typically a policyholder who no longer has a use for the policy, and we'll talk about that. And the buyer is ultimately an investor. And we'll talk about why a life insurance policy is an attractive investment. Leon mentioned that we'll be asking a question, and here's our first one. And I know there's some people from the life settlement companies who have signed up, but I want to focus in on trustees and wealth advisors on the line only. And I want you to answer the question, have you ever participated in a life settlement transaction? And we'll give you 10 or 15 seconds to answer. Okay, Aaron, let's see the results. All right, so about a third of you have participated in a life settlement transaction. 2/3 of you have not. And this is great because not many on the call have been part of the transaction. So what we want to do is provide you with the information that you need to be more comfortable doing this transaction. So let's talk about life settlements. John Burchard had two problems. He needed an operation, but he had no money to pay for it. So to solve his problem, he sold his life insurance policy to, believe it or not, his doctor, the same doctor that was going to operate on him. The doctor operated on him, kept the policy, paid the premium, and when Mr. Burchard died, which unfortunately for Mr. Burchard was not that much later, the doctor went to collect the proceeds. But when Dr. Grigsby attempted to collect the death benefit on the policy, the executor of Mr. Burchard's estate challenged him. The insurance carrier turned the case over to the courts, and eventually the case worked its way up to the Supreme Court. The Supreme Court ruled in Dr. Grigsby's favor. It upheld the first life insurance policy sale, with Oliver Wendell Holmes delivering the opinion where he said that limiting the policy owner's right to sell except to those who have an insurable interest is to diminish the value of the contract in the owner's hands. He believed it was desirable to give to life insurance policies the ordinary characteristics of property. In other words, life insurance was like any other property you own. You could buy it and you could sell it. And although Oliver Wendell Holmes set the legal precedent for life settlements in 1911, they really only became prevalent during the AIDS epidemic. People with AIDS had shortened lifespans and high medical costs, and they were allowed to sell their life insurance policy to a third party who would provide them with a lump sum cash payment, which provided them with the resources to live out the remainder of their lives in greater comfort. The first transactions were called viatical settlements, and they're still around today. It's a term that refers to the sale of a life insurance policy on a terminally ill insured, which is a person with 24 months or less to live. And for those people, there are tax advantages to the sale. But what occurred with these early sales is interesting because there were significant advances in the medical community around treatments for the disease. And many of the people who sold their policies lived much longer lives than expected. And so the early investors did not make the quick returns that they expected. But even so, this concept of selling life insurance and investing in life insurance policies caught on. But now it was not just limited to those who had a terminal illness. It expanded out to others, essentially people age 65 and up. So now life insurance, which up until this time had two benefits, the death benefit paid when you died, or the cash value that you could only really get all of it by surrendering the death benefit, now had this third benefit, the ability to sell a policy in the life settlement market, which when it started out, was a bit like the Old West. There was not a lot of regulation, and unfortunately, many of the policyholders were taken advantage of. Today, the industry, though it's still confusing to most people, is very well regulated, and like life insurance, it's regulated at the state level. So why do investors buy life insurance policies? Well, there's a couple of reasons. Life settlements are considered to be an alternative investment to traditional investments like stocks and bonds, and they can potentially provide very attractive yields. They're referred to as a non-correlated asset because the ultimate returns are driven primarily by mortality experience, not market experience. And this allows this asset class to provide diversification to an investment portfolio, which is why large investment firms or pension funds will allocate a small percentage of their investments to life settlements. Most policies are purchased with a built-in profit margin of 10% or more. And while the returns can be less than expected, they do exhibit lower volatility than the stock market, which is another real plus of this asset class. And now, in this incredibly low interest rate environment that we're living through, they're very attractive because they provide a higher than fixed rate return with a volatility level that's lower than the equity markets. So now question number 2, for any trustees and wealth advisors out there, have you ever surrendered or allowed a policy to lapse without reviewing the life settlement alternative? This is an interesting question. Okay, Aaron, let's close it out and see what we got. Okay, it's about 50-50. About half of you have surrendered a policy without reviewing, and about half of you have not. And we wanted to get an idea on how many did not look at the life settlement option, because I think both Aaron and I think that, it could be a mistake to not look at it. And this is really the big reason why we're doing this call today, is to provide you with the information that you need to be comfortable with dealing with you're going to be viewing it before surrendering a policy is not my call today, but the job today is just going to be to provide you with information. So why do you sell a policy? And there's several reasons for this. A lot of sales in the life settlement marketplace come from business policies, key man insurance or buy-sell funding, where a policy is no longer needed, or a policy purchased by a business to back a loan. And in every situation, there may be an opportunity to sell the policy. And more businesses are beginning to understand this. Your clients are able to grasp this concept. And certainly the estate tax changes have affected things for many of your clients. We've seen the federal exemption jump dramatically in the last few years. And now a husband and wife can effectively, they have to hit $22 million in assets to be subject to the federal tax. So many people who have life insurance trusts now purchased their life insurance when the exemption was 5 million or 3.5 million or even less, and they may feel that they don't need the policy now. And then there are some people out there who have had some sort of financial setback, and when you combine that with the increasing estate tax exemption, they feel they really don't need the coverage, and quite frankly, they would like to see what they can get for the policy rather than continuing to fund the policy. So certainly if you have a policy that's heading for a lapse, or if you're going to surrender a policy, we believe you should review the chance to sell it in the secondary market. And as a fiduciary, you yourself are going to have to decide whether you should have to review that option. But I would make the case that you should, and that you should have a process in place at your trust company, your bank, your family office, whatever, that everyone follows, so that when a surrender is contemplated or a lapse is imminent, you follow this process. part of the reason to sell a policy has definitely been the performance, or really what I should call the non-performance issues of the last decade. We're living in historically low interest rates right now. I mean, in the history of the world, these are the lowest interest rates, and it's affecting policy performance. And we've also had a rash of cost of insurance increases that have doubled the carrying costs overnight on some policies. So these are both real reasons policyholders are giving up on their policies. But again, as trustee, your job is still to maximize the value of the policy, even if the grantor gives up on it. So let's switch gears a bit. We talked about why people buy, why people sell. Let's talk about pricing of a life insurance policy. There's three main factors that affect the pricing of a policy. The first is the age of the insured, which really focuses in on the life expectancy of the insured. Most policies that are sold on insureds who are age 65 and up, but the real determinant is the life expectancy of the insured. So the first factor is age or life expectancy. The second is the size of the policy. What's the death benefit? All else equal, it makes sense that the larger the death benefit, the more the policy is going to be worth. And in the past, it was typical that only policies of $1 million and up were actually even sold, but that's changing. As a matter of fact, smaller policies are being sold now with a quicker underwriting process out there. So the third factor is the carrying cost. What's the premium needed to keep the policy in force? And this is really focused on the cost of insurance in the policy, because when an investor buys a policy, they're going to strip the cash value out of the policy, and then they're going to pay the minimum monthly charges to keep that policy in force. And then there are a couple of other smaller factors that should be mentioned. For example, what happens to the policy at maturity, which for many policies is age 100. You know, a lot of policies, and a lot of trustees don't know this, a lot of policies only pay the cash value at maturity. So if the investor is funding just the cost of the policy, that cash value at 100 or maturity is going to be zero. So there's a risk to the investor that they're not going to get their money back at all. And of course, the last factor in pricing is, what is the profit that the investor is going to build into the pricing structure? And as we mentioned, there's a much higher than fixed rate of return that's set as the goal. The rate of return is even higher than some equity investment goals. You're looking at 10% and above. If the insured has a shortened life expectancy, especially if the insured health has deteriorated since the policy was purchased, any permanent policy is going to be considered for life settlement. But a favored policy is the universal life chassis policy, especially current assumption universal life policies. And the reason is that these policies are very transparent. So an investor can see the actual cost going forward and then compute the minimum amount to keep that policy in force. Guaranteed universal life policies can provide an investor with a guaranteed premium, which might be something that they like. Term insurance policies are actually very popular if you can convert the policy to a permanent policy. And actually, I think one of Aaron's case studies is going to be on a term policy. Survivorship policies or second to die policies, where the benefit's not paid until the second death, is very attractive if one of the insureds has passed away. So the key again is that a policy with an insured whose health has deteriorated since the policy was purchased is the most likely policy to be sold. You know, we often talk about processes in all of our sessions at ITM 21st University, and the reason is attendees can take those processes back to their practice and utilize the process across the platform at their firm. And that's one of the reasons for the handbook, so you can look back at the processes we're talking about. Aaron Hansen, as Leon mentioned, heads up the remediation and policy analytics for the TOLI department. And his department has developed the best practices around TOLI, including life settlements. So today, He's going to walk you through the life settlement process and then some case studies so you can see how a life settlement occurs. And I'm happy to hand it over now to Aaron.
All right, thanks, Mike, and good afternoon, everybody. As Mike said, we're going to be walking through the life settlement process and the steps that you'll take when reviewing a policy for life settlement, and then also take a look at a few case studies to show you kind of front to back, the process that takes place. So starting with the initial review, when looking at a policy for options and then ultimately life settlement options, there are several things really to consider, and we start by looking at the overall situation and the details surrounding. Often a request may come in to surrender a policy. Maybe the client no longer needs or wants the policy. The estate requirements has changed, or something with taxation, and then what the policy is approaching a policy like a possible lapse. So we then move to reviewing the policy itself, along with the insured's details. So, starting with what type of policy is it? And this is important when we look at the policy type, because of the different options that are going to be available for that policy. Is it just a standard or a current assumption universal life? Is it a variable policy? Is it a guaranteed policy or have a no lapse guarantee? Is it a term life policy, or is it a whole life policy? And like I said, the reason we review these types and start with the policy type is these options are going to depend on that type. So for example, if you have a term policy, is a conversion option still available? Is there a level period? In which most cases the term policies we see are 10 or 20 years of a level period. We do see some with 30 years. If it's a whole life policy, is there a term blend? Or how are dividends being used? Can the policy self-sustain without additional premium, being paid out of pocket? When we get into universal, is there a guarantee? Is there a maturity extension, for the full death benefit? And when we talk about maturity, often and most generally, it's age 100, but it can be, age 95, or it can be 120. So we take a look at those details. And then, how long does a policy continue as it is? What's the current situation with the policy? What are the options there? Reduced death benefit and so on. There's a lot of different ways you can go depending on the policy type. So it's important, when reviewing it, that you have someone that understands those different policy types and what to request. So from there, we look at, the insured's information, their age, their health status. Is it a survivorship policy, as Mike had mentioned earlier? Are both insureds living? And then what is the current projection for the policy? Is it projected to lapse soon? Are we in a time deadline where something would have to be done quickly, or is it going to continue for 10 years, or is it going to run to maturity? So, it's important during that review, as well, that the policy information that you're looking at is current. We recommend annual reviews with updated policy information, including those values and illustrations. Now, if the policy is in a grace or a lapse status, the carriers are not going to be able to run new illustrations, which is, a pretty important requirement from the potential buyer that they're going to request. So it's important when you're reviewing and requesting information that it's done prior to a policy getting to that point where it's going into grace, and try to avoid any delays with reviewing those options. Now, after those reviews are completed, if the decision is made to move forward, a health questionnaire is completed to gather the basic insured information, which is going to include some health questions along with medical history of the insured. And then that form is also going to include policy details to provide the broker. Now, in addition to that health questionnaire, a HIPAA form is going to be required to be completed and signed. And the reason for that allows the life settlement advisor or the broker to request and review the medical records of the insured. Now, from there, a life expectancy report is ordered by the broker, the life settlement advisor. And then once obtained, a formal appraisal is prepared. Now, if the decision is made based on the feedback that is given by the broker to proceed with the life settlement process. Then an auction with the available buyers in that state is headed up by the life settlement broker. Now, generally, as Mike said, the higher the death benefit or the older the insured, lower the life expectancy, the more interest there will be from potential buyers, but it's ultimately going to come down to the carrying cost of that policy and the life expectancy of the insured. Now, after that auction process is completed, which can take several weeks depending on the interest from potential buyers, once that's complete and the auction is closed and the high offer is relayed to the seller or the trustee, if approved by the seller to proceed, then closing documents are prepared by the buyer and delivered to the seller. Now, these closing documents can be substantial and they may be a bit overwhelming. So it's important to understand and relay what is coming, because they can be in excess of 100 pages with multiple signatures required from the owner, trustee, the insured, if there's a power of attorney present, and then often the beneficiaries. In addition to that, generally a notary will be required in most cases. Now, once the signed closing documents are received, the buyer does a review and approves the closing documents if they're complete, or if there's missing information, they will come back with the additional requirements for that missing information. Now, at that point, once approved and the paperwork's in good order, the buyer then proceeds with changing the owner and the beneficiary with the carrier. And upon confirmation from the carrier of the titling changes, ultimately disperses the funds to the seller of the trust. Now, important to note that during this process, when we're reviewing life settlement options with the trustee and with the family, the seller, the trustee, the family, they're not bound to sell during this process. And generally, there is no out-of-pocket cost during this, and ultimately can stop the process at any time. So proceeding to get a life settlement appraisal and going through the auction is not a binding, but generally, there is also a rescission period too. So if it goes to the point where there is funding, the rescission period after the funds have been received is still an option and a timeline where the seller or the trustee could possibly rescind the transaction as noted. Now, once complete and the transaction and the titling changes are complete, the funds have been received, the buyer now manages the policy going forward and will ultimately collect that death benefit upon the insured's passing. The seller and the insured are no longer responsible for paying premiums, and then also will not receive the death benefit. So from there, we're going to move into our first case study. We're going to look at two policies today, or two cases. One is a variable universal life. The second case will be a term policy. Both are different situations, but I think it's good to see, how the situations drive the process essentially. Now, moving in here, we look at this policy where premiums have been paid in the past, but ultimately are becoming too burdensome for the family, and resources have been depleted. So the family is no longer has the funds to pay the premium needed. Now, with this policy, we're looking at $1 million survivorship variable universal life policy. Now, the male insured had passed away years ago, and the female insured is now 85. Now, premiums paid since issued have totaled over about $250,000, but this was not sufficient to cover the increasing cost of insurance deductions that we're seeing now in the current time, and with the cash value in the policy ultimately used to offset those increasing costs over the year. So now we, all too often, like we see and you see with flexible premium products, there's a misunderstanding or mismanagement by many that paying the planned or scheduled premium is going to be sufficient. The carrier has that planned premium in their system, and unless you change it since it's issued, they're just going to continue to bill that amount. Doesn't mean it's sufficient to carry that policy, but it is the amount that they're going to bill. And the unfortunate reality is, as in this case, is the family or the trust being faced with that increasing premium requirements, generally in later years, to keep that policy in force. So it's vital as we talked about, to review and communicate with all the projected policy performance and premium requirements to sustain that policy and what that lapse projection is. Now, in this case, the insured did have health issues, and the family was faced, like I said, with that unfortunate and potential lapse situation, unless they paid in additional premium. Now, over the last several years, options were communicated and reviewed with the trustee and the family, including reducing the death benefit to lower those costs and extend the duration of the policy. But ultimately, to the point it went to now, with little to no cash value remaining in the policy and a requirement for additional premium, any options within the policy itself would require additional out-of-pocket payments, and it just wasn't an option anymore. Now, based on the age and the health of the insured, along with the policy makeup, it was determined that life settlement may provide options. The information was discussed with the family, including the process, and the decision was made to proceed with review of the life settlement options. Now, policy information, current illustrations, statements, along with that health questionnaire and HIPAA form we discussed earlier, were completed and sent to the life settlement broker. And then an illustration as well, solving for that minimum premium to maturity. Now, the auction was completed by the broker with the licensed buyers in that state. And as you can see on the screen, there were 8 potential buyers in that state, with 4 buyers submitting offers. After the auction was completed, after about 2 weeks, the final offer came in at a high of $460,000 gross and $400,000 net to the trust after fees and commissions were paid. Now, the trustee then reviewed the high offer and details with the family, including their attorney. And after discussions, they made the decision to proceed with this sale. At that point, closing documents were then prepared by the buyer and sent to the seller for completion. And upon the completion of the documents in good order, the funds were paid to the trust, and ultimately that ownership was changed to the buyer. So when we look at this example, the life settlement option really provided the trust and family with a desirable option that maximized the value of the policy without having to pay additional premium versus allowing to lapse with zero value. Now, in addition to receiving the funds, it alleviated the pressure and the stress the family was experiencing by the increasing premiums, which included worry about having the policy lapse. They no longer had that over the shoulder. So there's multiple reasons in this situation that the correct decision was made. Now, when we move into our second case, is a little bit different situation, but we're looking at a $5 million term policy. Now, the insured and grantor, he was both, of the trust, he no longer needed this coverage due to changes in his estate. And while the policy was still early in the level period, he alerted the trustee that he's not going to be paying the additional premium coming up, or the scheduled premium, and just requested the policy be allowed to lapse with no value. Now, this type of request is, I would say, relatively common when clients no longer need the policy. They just say, you know what, just let it lapse. I don't want to worry about it anymore. And everybody's situations change, from when policies are purchased to today. Now, in this case, what was unique, the insured was a little bit older. He was 70 with a term policy, which is on the high side. And then he was also not in the best of health. So as we discussed earlier, when reviewing policy types, we start by looking at, in this case, a term policy. We're looking at what's the level period and is conversion still an option. Now, this policy had 15 years remaining of that 20-year level period. And it also had the conversion option, but that conversion option would be expiring very soon at the next premium due date around age 70. So this conversion option, if you're not familiar, provides the trustee or the owner with the ability to convert that term policy to a permanent policy without having to go through underwriting. Now, so for this example, if the term policy was issued with a preferred underwriting class, the conversion product, or that permanent product, is also going to be issued with a preferred underwriting class. This is very valuable in cases where an insured has experienced a change in health since the term policy was issued, and they would no longer be able to qualify for those preferred rates. Now, conversion options will vary from carrier to carrier, with some carriers only offering one option, often just a standard whole life policy, while other carriers may offer their full suite of products. It could be universal, guaranteed UL, universal, index, variable, in addition to that whole life. Now, in this case and with this carrier, several conversion products were available, and based on the insured's age and health, life settlement options were likely available. So details on this potential life settlement alternative were relayed to the trustee and the insured for discussion, where the policy could potentially be sold versus allowing it to lapse with no value, explaining the process of what would be entailed, and the decision was made to proceed with that life settlement appraisal. This included, like we discussed before, a health questionnaire with the insured's basic information, along with the HIPAA form, and then the conversion product details, because ultimately the potential buyer was most interested, not so much in the term policy itself, but the conversion product, as it was a well-priced option that would run to age 100 and beyond. This was sent on then for appraisal. Now, the auction was completed, just like the case study one that we looked at. Ultimately, with this situation, the high offer came in at $150,000 relatively soon, and I think in less than a week. Now, the requirements of this offer are a little bit different than a standard life settlement sale, if there is such a thing as a standard. They required, in addition to the standard closing documents, that the trustee convert the term policy to the permanent product and also make that initial premium payment to put that permanent product into inactive status. Once that was completed, the buyer would then be able to proceed with titling changes and payment. So with this case, when we look at, while the insured and the grantor had no interest in keeping the term policy, had no longer need for the coverage, they were unaware of that potential option where there was value there, and the alternative of receiving $150,000 gave them a substantial value that could be seen by the trust. So we don't see a lot of terms going in through the life settlement process, but in cases like this, they are out there, and it's definitely recommended of reviewing each and every policy, regardless of type, versus allowing that to lapse with no value. Now, looking at turning this back over to Mike now for discussing the other creative solutions that we can look at.
Thanks a lot, Aaron. Great job. One of the things I'm hoping we're emphasizing here is that this is a session on life settlements, but it's really in the context of maximizing the value of a policy for your clients. And there are times when a life settlement makes sense, but there are times when outright selling a policy is not the best outcome. For example, what if you have a client with a very short life expectancy, maybe even one in hospice, as a trustee who called me last week, who's probably on this call, had a client in that situation, and you have clients that do not have the money to pay the premium. One of your options could be to look for a loan through the grantor or the beneficiaries, but also there are proprietary programs out there that utilize life insurance policies specifically in this situation, where you'll pay a fairly high interest rate and maybe even give up a little bit of the death benefit, 3%, for example. But if you can keep that policy in force when somebody with a very short life expectancy, you're going to get a much better outcome than if you sold the policy in the life settlement marketplace. Another option out there is that you can split the death benefit, where the trust can retain a portion of the benefit, and then the investor can take over the premium payments and get a portion of the death benefit. So what we're trying to do today is to give solutions, because each particular situation for your client is going to be different. So now I want to take a couple of minutes to talk about the taxation of life insurance sale. A life insurance death benefit is received tax-free, right? But a life sale, like a policy surrender, can trigger taxation. So let's take a look at that. First of all, the taxable gain is equal to the difference between the cost basis in the policy and the amount received for the policy sale. And the cost basis is always received free of income tax. It is actually the return of the premium paid. So In this instance, where we had a policy with 20 years of $10,000 premium, the first $200,000 would be received back free of any income tax. And then anything above the cost basis, which in most cases is just the premium paid, is going to be taxed. So in our example here, we received $400,000. We had a $200,000 cost basis, so $200,000 would be taxable. The question is, at what tax rate? And the difference between the cost basis and the cash surrender value is going to be taxed at ordinary income tax rates, just as if you are going to surrender a policy and get $250,000 back in cash value with a $200,000 cost basis, you're going to pay tax, ordinary income tax on $50,000. And then the amount received above the cash surrender amount, that's going to be taxed at capital gains rates. And the reason for that is that this is considered investment income, since the policy is sold for more than could be recovered by just surrendering the policy back to the carrier. So in this instance, the difference between $400,000 of the sale price of $400,000 and the cash value of $250,000 or $150,000 would be taxed at capital gains rate. So to recap, the cost basis, excuse me, is always returned income tax free. The difference between the cash value and the cost basis is taxed at ordinary income tax rates, and the amount over the cash value is taxed at capital gains rates. But typically, the policies that are sold have very, very little cash value. Many policies that you're selling are going to have cash value that is dissipated over the years. So in most life settlements that you do, the entire gain, that amount over the policy cost basis, is going to be taxed at the capital gains rate. One thing to note, there is a bill in Congress now called the Senior Health Planning Account Act that would allow you to roll over the proceeds tax-free into an account if you're going to use it for long-term care expenses. But it's essential that if you do a life settlement, that the tax ramifications are laid out for the client and that there's an explanation of the taxes due that's made part of your process. And now, to round out our presentation, Aaron's going to go over a prudent process for trustees to follow.
All right, thanks, Mike. So let's go through the important 5-step trustee process here. Starting off with, we kind of touched on this earlier a few different times, reviewing all options with the policy. So when we talk about reviewing options and deciding on a plan of action, really need to review the current information, request updated information if needed. And these policy details that we're looking at are going to include, what is, in addition to that policy type, what is the projected duration, based on that current funding. If the policy duration is not meeting the expectations of the client, what are the premium requirements to meet the needs and possibly continue to maturity. So we want to lay that as the baseline of where the policy sits right now. Then you get into what are the options available. Is there a reduced death benefit option, or is there a no pay option? So if someone's coming to look to surrender a policy, well, maybe additional out-of-pocket premiums aren't required. If the insured is healthy, maybe it's possible to replace that policy with a better price policy. If the insured is willing to go through underwriting and utilizing the cash value, if any's remaining, via 1035 exchange. And then, as discussed today, including the life settlement review, as it may be a prudent option with that policy. The second step we talk about is documenting the trust file. This document should include, just like we talked, the current policy details, the available options, what's been discussed, and ultimately what the plan of action is. This document would be delivered before any changes were completed, and that's important to note when you're looking at whether it's changing the death benefit. Definitely, if a surrender or any type of changes like that are going to incur. And this policy document should be included and sent to all parties pertaining to that trust, and that could be including the trust beneficiaries, definitely power of attorney, and co-trustees if present. along with the grantors and insureds. The goal is to make sure everybody's on the same page at least and understand what options are available. The third part of this process is, will the beneficiaries fund the policy? In many cases, the beneficiary may not be fully aware. One, they might not even know they're a beneficiary of the trust, but they may not be fully aware of the situation and requirements, or that the policy may be nearing a lapse. So with this, it's important to include beneficiaries on the options available. Sometimes it can be a tough conversation with the grantor if there's family issues or anything like that. So it's a sensitive topic, but one that needs to be included. And Mike, did you have any thoughts on in addition to that?
Yeah, I mean, this is an area where I really suggest that trustees get involved and allow the beneficiaries to understand exactly what's going on, because it's going to limit your liability. But the other thing it does is it builds a bridge to the next generation. And I think that an important part of this process is bringing those beneficiaries into that process.
Definitely. The fourth step that we look at, that we went through, reviewing life settlement options. This does include the existing policy options, and then you get into the life settlement options as well. And as you can see, this includes getting the updated illustrations from the carrier, reviewing the client health, including that health questionnaire and potentially HIPAA, moving on to a policy valuation. And then if it makes sense and the offer, potential offers look good, moving ahead to the auction. And then finally, that last step is just memorializing the outcome for the trust file. It's important that everything that's been done has been noted. It's been documented in the file based on the current situation, current facts, and that everybody is on the same page and acknowledges.
And Aaron, this is maybe one of the most important parts of this whole session today is that everybody who is a fiduciary understands that not only do you memorialize this in a file, but that file is at a central location. The chances are, if you have to go back and justify something that you did, it's going to occur 5 or 10 years down the road, and maybe occur when the person who did make the decision is no longer at the firm. So it's important that you memorialize the outcome in a central location that you can get to in the future.
Hey, and Aaron, this is Leon. I'm going to pipe in with a question, and I'm recalling from memory probably 10 years back, but I think that I recall a case that you and Mike, and it came across our desk where we really couldn't get a trustee to respond to whether or not the life settlement option should be considered, and the monthly COIs were like huge amounts of money, and it took like 7 months before the trustee really gave a indication to move forward. And as I recall, in some of our meetings at that time, I was just appalled at how much lost value was caused by just no communication, no response, no ability to really take steps forward. And when you've burned $250,000 or more in cost of insurance, that certainly impacts your options when it comes down to where the policy's ready to lapse, or you're waiting to get an offer to sell the policy, what that amount of that offer is going to look like. So it is important to identify and move quickly, is it not?
Yeah, definitely, most definitely. There is, I think, overall, I don't know if it's hesitation on life settlement or maybe just lack of just fully understanding what life settlement options may be with many trustees. So I think it's important as we move along, and I think this session or sessions like this are important to spread the knowledge, to help people understand that it is a viable option, and it's also important, like you said, to get ahead of it as much as you can. We run into cases where, whether it's lack of response from a grantor or beneficiary. Thankfully, we have a great group of trustees that we work with, and corporate trustees that response times are pretty good. But it's important to communicate the options and what time constraints you're on. When we look at, for example, reducing the death benefit as an option, Options like that are generally geared on what cash value is still in the policy. So in that situation that you were just talking about, allowing that cash value to deteriorate, or that policy to eat up that cash value, really removes potential death benefit reduction options, and pushes more towards life settlement being possibly the better option as an alternative to, especially if they don't have funds to pay premium.
Great. Super. Do we have any questions?
Yeah, we do.
We do. I can throw a couple out here, Aaron, for you and Mike, if you'd like.
Sure, go ahead.
First one is, if a policy sells for less than the cost basis, can the trust claim a loss?
That's a good question. Mike, do you want to, regarding the taxation area, do you want to jump in on that?
Yeah, and I'm not an accountant or an attorney, a tax attorney, but I believe I'm 99.9% sure that you cannot take a loss on that. No. And if whoever that is, I'll be glad to double check on that or triple check on that. But I'm almost 100% sure that you cannot take a loss.
No, that is true. You can't take a loss on that, Mike. I mean, everybody should get their own tax advice, but if you sell it for less than that, you cannot write a loss off on the life insurance or the settlement.
Just as if you surrendered it or lapsed it, you couldn't.
Correct.
All right, next question. When funds go to the trust, generally is the trust then distributing those proceeds, or does it stay in the trust until death?
I think in the situations that we've seen, it generally depends on the trust document, and ultimately, dictating on what that allows. I think we've seen distributions and the trust ultimately closed, but we've also seen where the trust then manages the cash in the trust. So I think it'll vary from trust to trust.
And also, let me jump in here and say, when we talk about creative solutions, I've seen situations where a trust had 3 or 4 policies, and maybe one of the policies, for one reason or another, wasn't performing or had less cash value, or was one that would be best to sell to fund the other policies in the trust. So, it's not just there's one policy in a trust that we're going to sell. There's a lot of creative solutions out there where we're using money from one policy to keep the other ones going. And an analysis of which is the best to sell and which is the one to keep is important in that situation.
Mm-hmm.
Great, thanks. Next question, is there any guidance on fees or percentages as it relates to the broker or the auction process? Any thoughts there? Standard rules of thumb for the industry and whatnot?
Aaron, you want to say, have you seen that?
No, I'm not exactly for sure. If it's
Well, I think ITM 21st, we don't participate in any of those transactions. So we don't, all we are is the conduit to do what's best for the trust. So I have no idea what the commissions are on these things.
Let me just say this, that typically it's based on a percentage of the death benefit or a percentage of the additional value received. In other words, if the policy had $100,000 of cash and you got $500,000 in your for your life settlement, it would be based on the difference between the two, and it's usually the lesser of those two. The one thing I would say, and if specifically, if someone wanted to reach out to me directly, I'd get into specifics. But the one thing I will say, in every situation, if you sell a life insurance policy through a broker, that is going to be explained to you down to the penny, so you'll know exactly what the costs are. But it will cost a commission to the broker to make that transaction.
And I think important to know that.
And then we have
just to add in on that, there is no necessarily an out-of-pocket cost for the life settlement from the trust. It would be, I do know it would be taken from the sale proceeds directly when paid.
What about who pays for life expectancies? Who pays to get the medical records? Who does all that work and covers those costs?
That falls on the life broker or the life settlement broker that runs. So those out-of-pocket costs, like I said, nothing comes from the trust or the family. during that process. So that's on their dime, and that's understood from the get-go.
Great. Thanks. There were a handful of other questions. So if we did not answer your question directly, we will follow up with you with a response. Thanks for everyone who submitted questions.
I think there was one more. Yeah, there was one of my. Did living needs riders put a dent in the viatical market in the last few years?
I don't know that it's put a dent in it, but that's a great question because we really didn't talk about that because we were really focused more on maximizing the value of the policy, whereas that's typically a situation where a client is in more of a viatical situation. But taking a look at the ability to advance part of the death benefit is part of the process if you have a client that is very, very close to death and somebody who is within 24 months, for example. That's a great question.
Well, we certainly stirred the pot with questions today. I hope the polling experience was positive. I think it's something that is useful on our end to better understand the audience. We'll continue to incorporate those into our future sessions. Mike and John and Aaron, thank you guys all for doing the research and homework to pull this together and do the presentation today. You know, Mike Brohan is an independent provider, somebody you can contact. Aaron is somebody you can contact here at ITM 21st. Happy to help you in any way that we can. And we hope that we will see all of you on our next session in a couple of weeks on June 24th and be talking about discretionary, delegated, and directed trustees' role and the trust protector. So with that, everyone enjoy the next 2 weeks and we'll see you all soon. Bye-bye.